The wash-up from the Jackson Hole summit in the US last weekend was relatively positive in its messaging, effectively locking in the December US rate rise on the stronger jobs market, and even the chance of an additional increase prior to the election, although we still favour just one hike on December the 14th. The realisation of more imminent US rate hikes has pushed the Aussie dollar lower, although as the chart shows, the currency isn't too fazed by this prospect, or at least not yet, with fairly orderly falls, probably reflecting the fact that higher US rates are well and truly built into the markets already. So, as we've been saying for a while, don't bank on a lower Aussie dollar just because the US rates will be going back up to 1%. More importantly, the data out of China yesterday was much better than expected, with their two manufacturing PMI indices both back above 50, so back into positive territory. Evidence that their short-term measures are shoring up growth in our major trading partners' key markets. But locally, the economic data was mixed to muddling, with firstly capital expenditure spending down 5.4% last quarter. Disappointing, although, as the red line on the chart shows, the non-mining component is just in positive territory, coming in at 2.2% growth for the quarter, and in line with the NAB business survey. So we do continue to see progress in the investment transition post the mining boom, although mainly in New South Wales and Victoria, and not in the mining states themselves. The second piece of local data was retail sales, which you can see here were flat in July. And here, the excuses were that this was prior to the latest rate cut and was primarily due to department store sales, which fell 6.2% for the month. The strongest retail activity was in restaurants, cafes, and also furniture sales. But again, the two-speed economy was evident, with WA and Queensland lagging the non-mining states. So with the RBA meeting next week, which is Glenn Stevens' farewell appearance before handing over to Philip Lowe, we won't see any change to the official cash rate, but we'll keep a lookout for any changes in the messaging. Perhaps the RBA will deliver a less than subtle message for Canberra to play nicely and deliver on fiscal policy, as monetary policy is virtually all in. I'll see you next week for the market update from Bendigo Bank.